Well, this is Bloomberg.
Equities are just about holding on here from New York City. Good morning to you all. This morning, the price action down a tenth on the S&P, no drama so far. On the Nasdaq, down about 1/3 on the Russell, down a single point, negative 0.05%. The up and about in New York City rings, switch up the board and get to the bond market. We look like this on 10s. Yields breaking out again at 4 basis points and pushing 196, 195. 59. Not just stateside, on the other side of the Atlantic too. In Europe, look to Italy for a 7th straight day. Yields are higher in Italy, 187, let's call it 188. In 7 days, we're higher by almost 60 basis points. So keep going back to this. Think about the move we've seen year to date in 10-year yields in America. It feels brutal, right? We've done more than that in 7 days in Italy as the ECB tees up doing something maybe in the back half of 22. In the FX market, euro dollar just a little weaker on the euro side of things. We're negative there on that currency pair, 0.2% to 114.17, and crude backing off 1.6% on WTI to 89.85, down about $1.50, down by 1.6% to be precise. As we open things up on the S&P about 50 seconds in, we open negative 0.01%, positive now, no drama. Bottom of the pile communication names, we're down 0.4% at the top off the back of this move in treasuries. Yields higher, treasuries up, yields up, financials up by 0.7%. Here's the quote from HSBC that got our attention. It reads as follows: we think the next big thing to cut will be cyclicals in Q2, as it will become increasingly clear that global growth momentum decelerates in earnest. The crucial question then is whether the Fed is more likely to hike 3 or 7 times from the current 5 being priced in. Eric Knudsen, that's your world. That's what you're thinking about. Why is it so important?
Yeah, I mean, that path of the rate environment, and again, whether markets are trading inflation and rate increases or a declining growth environment, is going to be critical for the market setup. We do think that we won't go with HSBC in terms of the timing of that. We think there's more room for cyclicals to go here. We want to be underweight unprofitable tech and to a certain extent big tech at this point through another portion of the period here, get through kind of peak hawkishness with the first rate hike in March, and then see when in the second half of the year we start shifting more towards that orientation towards growth slowing versus inflation and rates. I will say that the other aspect here is that volatility is going to persist. We want to be able to take advantage of volatility. So another way to play this exposure is to express some of those views in the options market through selling options and capturing attractive volatility premium at this point in the cycle.
Ella, there is a difference between deceleration and weakness. Growth is set to decelerate. It doesn't necessarily mean it will be weak per se. Ella, your thoughts on that?
Well, the consensus entered this year thinking that growth would decelerate. So we don't think that would be the surprise for markets. So you have to think that this deceleration is probably already reflected in the price. So what would be the surprise would be if indeed we actually trade much lower than that in terms of the prints that we get. That would probably catch central banks off guard because they're also operating on the basis that growth, although coming off from the very high levels of last year, will still remain at elevated levels. So that could change the macro backdrop pretty significantly.
Jack, 2 pieces to this call. Global growth momentum decelerates in earnest. 1, 2, cut cyclicals. Jack, where are you and the team on cyclicals at the moment?
Yeah, I would generally speaking agree with what Eric had to say, which is that I think there is more room to run than just through the second quarter on cyclicality. And I think a lot of that has to do with the fact that particularly in the U.S., there is still more momentum from a growth perspective. I tell clients, I don't think we're on the cusp of a paradigm shift where value or cyclicality is going to outperform over the next decade relative to growth. I don't think that is the case. But if you look at the high-frequency economic indicators that are out there for things like the travel industry, leisure, hospitality, you see how these things got beaten up because of Omicron. I think there is at least a couple more quarters of strong growth to come before the economy starts to settle back down into a more ho-hum kind of pedestrian pace. And if that is the case, it is those value names, it is that cyclicality that is more levered to that growth story. In particular, John, and I've said this before, so I know we've talked about it, but I do still like the financial story. Now, a lot of that hinges on what the Fed ends up doing. How effective is it in controlling the shape of the yield curve. But I am generally speaking an optimist on that front, and I think that this could be a really nice environment for big banks to make a whole lot of money as long end yields drift higher and that curve maintains some sort of steepness, or I should say steepens as QT begins in earnest.
Let's come back to that call on banks in just a moment. Two earnings stories I want to pick up on. Pfizer number one, down 5% of the open after the outlook misses estimates for 2022. Just about in positive territory. Peloton, after getting absolutely slammed yesterday, that's up by about 1.5%. On the West Coast, let's get to Ed Ludlow for more. Hey, Ed.
Yeah, morning, John. Peloton bouncing all over the shop. And the big news is that John Foley, the CEO and founder who brought this company into being a decade ago, is stepping aside and becoming executive chair. Barry McCarthy, you see there on the right hand of your screen, he's a former CFO at Spotify, former Netflix executive. He comes into the fold as CEO, and the street likes this, John. JP Morgan's Doug Anmuth calling this a known entity move, somebody that's very familiar with subscription-based businesses. And that's the story for Peloton, right? That's what we want to know about the future. How do they manage and transition to a higher margin services and subscription-based revenue? But it also raises a question about the other elephant in the room, John. Does this increase the likelihood of a sale? Because one of the barriers or fetters to a takeover by the likes of Amazon or Nike was this dual class structure, and Foley being a holdout, basically, right? It makes sense. He was the founder. This was his baby, but he'd come under criticism for his management and abilities. You see there, that chart says it all, right? We're well around that IPO price. It's been an 80% drop from the peak of the pandemic. And the story's been that, you know, folks have gone back outside of their living rooms and started using gyms. So the big question for earnings after market today, what is the future? Even if it's not a sale, what is the strategy, and how do these C-suite changes make that happen?
Ed Ludlow, thank you. I should say it got slammed last week. Massive pop yesterday off the takeover rumours, up 21% yesterday, almost 21% of the close, up 4% right now on Peloton. Last week on Thursday, that was ugly at one point, down 9%. It's had a tough time more recently. More earnings. Let's get to Abby for a whole lot more than that. Hey, Abby.
Hey, John. Well, you know, it's super interesting because, of course, all focus on the CPI print later this week and the inflation story that we've all been watching. So far, it's not really affecting U.S. companies on an individual level. In fact, we're seeing a lot of consumer companies in particular really absorbing consumers absorbing price hikes, and that margins are staying steady. In fact, this morning, we had Harley-Davidson report a much better quarter than expected. Sales up 21%, a surprise profit. Those price hikes being absorbed. Tyson Foods yesterday, consumers really absorbing those rising prices as well. That said, margins are not hanging in there for all companies. Right now, for the first quarter of this year, margins down almost a full percent from the peak back in the second quarter of last year at 13.9%, currently at 13%. Nonetheless, you can see relatively holding steady over this year from relative to last year outside of this trough right now. And interestingly, if we break it down just a little bit more, we're seeing a real shift versus the prior year in margins. Communications getting hit pretty hard, discretionary as well, staples down just a little bit. But if you can see it, people seem to want it. Materials and industrials, that cyclical call that one of your guests was just talking about, well, right there, you can see that the margin is hanging in for those two sectors.
Abby, thank you. 8 minutes in, unchanged on the S&P, on the Nasdaq, just about positive 0.06%. Let's talk about the small caps. Julian Emanuel of Evercore weighing in on the small caps. He writes the following: small caps have shown signs of sputtering below their prior support, with Russell 2000's recent track record as a leading indicator for broader market weakness. We will be watching the reaction to this level closely. Eric, can I come to you on the small caps in America? A lot of people talking up this as a potential part of the market that will be okay with rising rates, inflation being a problem too. What are your thoughts?
So in general, we want to be overweight small caps. The category, by and large, is pretty sensitive to economic growth and reflationary pressures. That said, you know, what we think is incredibly important at this juncture is to focus on kind of quality versus non-profitable small caps. Over a third of the Russell 2000 index are comprised of companies that are not profitable. That's the category that's a portion of the category that's really gotten hurt this year, and we think will continue to face pressure. You can combine that orientation towards smaller companies that are geared to reflationary growth with quality earnings, quality management teams. We think that's a great opportunity set right now.
Jack Manley, your take.
I think what Eric said makes a whole lot of sense, and I'd add on top of that that there is a very compelling valuation argument to be made on the small cap side of things, particularly on the small cap cyclical side of things. You do want to look for that quality. You do want to look for the ability to generate earnings. You do want to look for solid management, but I do like the idea of small caps. I would just say that any client or investor that is thinking of getting into the small cap space needs to recognize that it is inherently a more volatile part of the market. It's not going to do the same thing as large cap, very high quality kind of blue chips name will do in a portfolio. So understanding that there is more risk associated with that space, I do like that play. I do like that call that Eric made, that I think we want to have a little bit more exposure to small caps than we typically would otherwise, just because of that strong growth story, that strong reflation trade.
Jack, you mentioned the banks a bit earlier. Let's finish there with you. Why the banks work in a world where you think the Fed will disappoint on the level of rate hikes that are currently priced?
Yeah, John, it's a little cheeky, but I'll tell you how I think about this. I don't know where you bank. I won't say where I bank, but I can tell you when interest rates are at 0, I get about 1 basis point on my savings account. The Fed could hike interest rates to 2% tomorrow, and I'll still get about 1 basis point on my savings account, right? A lot of these big banks are able to hold a lot of that extra money. They're able to eat up all that upward pressure on rates by passing it on to you on the long end of the curve when it comes to lending for autos, for mortgages, on your credit card debt as some examples. The net interest margin story there is, I think, a lot more powerful than the overall yield curve that some people may be focused on, because even if the Fed were to normalize short rates and we were to see a flattening yield curve, that doesn't necessarily end up being what the end consumer feels. And so I look at this environment and I see long end yields drifting higher, especially if the rest of the world starts to normalize as well. That is an environment where net interest margins lead to enhanced profitability in those big banks.
Jack, if Jamie's watching, you should tell him now that you bank with Chase, just to clean it up and get ahead of a problem. You should bank with Chase, I imagine. I want to finish on this with you, Ella. The potential for a steeper curve, you push back against that. You believe in a flatter curve from here. Is that a global call for you, Ella? Does that include Europe as well, or is that just the Treasury market?
Right. So yes to flatter curves, and that's predominantly because the market still needs to find what the end point is with regards to terminal rates. Does it join the Fed, which we've been doing, so we're moving in that direction, or as we were saying earlier in the session, potentially even higher. So very difficult to say here. We'll need to assess the growth and inflation backdrop, but we are certainly on the camp that thinks quite a lot is priced in the curves here. 7 hikes from the Fed is pretty excessive. So in order to not disrupt the growth backdrop, you need to kind of pull back from the amount of hikes that you have in, at least over the course of this year. So that's on the US. On Europe, we had been more on the sort of steepening curves debate, but clearly the shift from the ECB is actually pointing in the other direction. And you saw 10-30 swaps in Europe actually start to invert following the ECB meeting, which is telling you that the market thinks the policy setup there is also getting pretty tight or excessively tight. So we're certainly seeing more value in flatteners there, with the belly of the curve, so the 5-year part of the curve, still exposed, in our opinion, to continued repricing.
Ella, thank you. Awesome to have you on the programme. Ella Hodger there with Eric Knudsen and Jack Manley. Coming up, what a contrast. Australia opening to tourists, Sweden scrapping its COVID curbs, mask mandates slowly going out here in the United States, and Hong Kong going the other way.
It's biologically implausible to eradicate or eliminate an efficiently spreading respiratory virus that has an animal host. So COVID-0 was wrong from the beginning.
COVID-0 on China, on Hong Kong. That's next. This is Bloomberg.
think that you're going to see many of these mask mandates at the state level stand for much longer. And indeed, many states, including my own in Pennsylvania, have not had a mask mandate for months and months.
What a contrast. Let's just sit on this for a moment. Sweden getting rid of its COVID curbs, basically all of them. Australia reopening to double vaccinated tourists. And here in the US, state after state making a move. Connecticut, New Jersey, Delaware, all dropping school masking mandates. Over in Hong Kong, we're going the other way. The chief executive, Carrie Lam, saying this: now given this severe epidemic, I hope the public will accept that we have to go back to the most stringent level of restrictions. Bloomberg's Mike McKee joins us now for more. Mike McKee, that is quite a contrast.
It is quite a contrast. Changes in latitudes, changes in attitudes. It's all about the virus and where it is hitting. And for us here at Bloomberg, it is about the economic impacts and, to a lesser extent, the political impacts of all of this. I want to start north of the border with Canada. Oh, Canada. That bridge that's been blocked by truckers between Detroit and Windsor, Ontario, carries 25% of the U.S. and Canadian land trade traffic. And it is a major impediment to trade in the U.S. and Canada. Truckers still disrupting life in the Canadian capital, Ottawa. PM Justin Trudeau today accusing the truckers of trying to blockade our economy, our democracy, and our fellow citizens' daily lives, which is interesting because this comes just as U.S. states are starting to loosen up. As the pandemic fades, we're seeing Connecticut, New Jersey, and Delaware announcing they are going to start phasing out mask mandates for school children. And then you go across the pond, and Italy ending its outdoor mask mandate. Austria, Sweden, the Czech Republic going to let most of their mandates lapse. Even the Germans are talking about it. In Australia, border controls being eased. That's not enough for protesters who blocked roads in the capital of Canberra there. Protests also in Wellington, New Zealand. Most of the easing, as I mentioned, comes as COVID cases are falling rapidly around the world. But Greg Valle, who's the political analyst at AGF Investments, wonders today if the protesters are going to take credit for this, leading to even more protests, not just about COVID, but about other social issues. No protests in Hong Kong, though. As you mentioned, leaders there increasingly adopting the mainland policy of no COVID, zero COVID, limits on gatherings imposed today. Residents also dealing with some food shortages because truckers can't make it across the bridges to Hong Kong.
Mike McKee, two different worlds. Thank you, sir, on the latest of these restrictions. A number of years ago, when Chinese state funds started to go into the equity market, it was quickly called the Plunge Protection Team. Do you remember that? We used to have that name for what happened in markets here in the United States a while ago, too. Overnight, apparently that's what we saw. Equities bouncing off the lows, reportedly because state-backed funds came into the market to buy Chinese shares. We get to Damien Sassow for more on that. Hey, Damien.
Hey, how are you, Jonathan? So yeah, that's exactly right. The market was down 2.4% overnight, and then the Plunge Protection Team came right in and got the market back up to where it needed to be, I guess. Look, China's equity market is in a bear market. I mean, it's down 20% off of last February's high. The reality is this. What is driving the weakness? It is weak consumer spending. It is weak tourism. I mean, tourism receipts are down 70% year over year in China, 70% since pre-pandemic levels, sorry. And movie box office receipts down 20%. All this data is coming in. We knew it was going to be a weak Lunar New Year holiday, Jonathan, but not this week. And so on top of that, you see BABA listing shares here in the U.S., which means SoftBank selling. You see 33 new entities added to, a U.S. kind of banned list. So, yeah, you had quite a bit to drive the market lower. And of course, here comes state-backed funds in China riding to the rescue once again.
Unreal, Damien. They're going in one direction. We're going in another. Globally, we have to sort out the supply chain situation as well, Damien, and I just wonder how we do that. Dr. Amish Adalja of Johns Hopkins was on with us earlier this morning on Bloomberg Surveillance, and he said the Chinese, China, Hong Kong, they're going to find it very difficult to open up.
Yeah, no, impossible. I mean, zero COVID just can't work. I mean, look, we all know this. It's a matter of whether or not they relent. I mean, look, if you believe that China's going to stick with it, they're going to have to cut rates. They're going to have to front load all of their total social financing inflows in the first half of this year. And what's that going to do? It's going to drive rates that much lower. I mean, 3-year China-U.S. yield spread is now 70 basis points. 70 basis points. It was 300 in November, Jonathan. 300. The 3-year spread between China and U.S. yields is at 70 basis points. That means the yuan has has got to depreciate from here.
Damien, people can criticize the plunge protection team and laugh about it, but do you take some real signal from that?
Absolutely.
Isn't that important that there is a real shift taking place
Well, what they're buying, right? I mean, what were they buying overnight, right? They were buying utilities, energy, and financials, and not just any financial. They weren't buying property developers. They were buying brokers. They were buying banks. So it just goes to show that's where China's head is at. And, you know, you don't really want to fight the PBOC and you don't want to fight Beijing.
You've got to listen. You've got to pay attention. As always, Damien, thank you, sir. Damien Sassower of Bloomberg Intelligence. Let's get you some sector price action this morning. As always, we can do that with Kriti Gupta. Hey, Kriti.
Well, good morning, John. Well, it's pretty clear what the story is in the stock market. It all really comes down to the cue that the bond market is leaving. Your leaders this morning are going to be financials, utilities, and materials. Financials, of course, following the lead of that 10-year yield, which is nearing 2%. With it, you also see some other yielding sectors in the green. Utilities, consumer staples as well, nudging higher. But your laggards are once again going to be big tech and energy, which is actually taking a breather. Pretty normal, just given the run-up that sector has had. One of the biggest weights on an individual level is going to be NVIDIA, though. This, of course, comes off the ARM deal that now actually really fell through. SoftBank saying instead they're going to pitch it as an IPO. So, of course, weighing on NVIDIA, not just for the S&P 500, but for the SOX index broadly. But today, on an intraday basis, the SOX index actually in the green. You'll remember, John, it wasn't too long ago where chip makers and EVs were actually booming, and this idea that this was going to be the next big thing. In this year, however, in 2022, that is not the case.
I used to interview the CEO of ARM when it was listed in London, and now we're talking about relisting it after buying it. And Kriti Gupta, thank you very much. I think Anna Edwards earlier this morning said it was back to the future for the likes of ARM and maybe others too. Equities this morning down about 0.1%. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. From New York, this is Bloomberg. .25 minutes into the session this morning. Good morning to you. We're down just a little bit on the S&P by a little more than 0.1%. Banks lead here. Bottom of the pile. The Nasdaq down about 0.2%. Let's get you a read on the why. It's in the bond market. We can talk about twos and we can talk about tens. Twos right now at 133. Tens at 197, almost the highest since the summer of 2019. A 40 basis point plus move year to date so far. That's the price action. Let's get you the trading diary. The US auctioning $50 billion of 3-year notes at 1 p.m. 10s and 30s later in the week. President Biden delivering remarks at 1:45 Eastern time. Wholesale inventories coming up on Wednesday. Plus, we'll hear from some Fed speakers too. Then a little bit later in the week, another read on inflation on Thursday. CPI, the big one, and initial jobless claims coming as well. We round out the week on Friday with the University of Michigan Consumer Sentiment Survey from New York City. This was the countdown to the Open. Thank you for choosing Bloomberg TV. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, February 8th. Here are the top market stories we are following for you at this hour. Closing in on 2%. The 10-year Treasury yield inches higher and traders see that nice round number in sight. It's just one part of a bond sell-off rippling across the globe amid expectations of more aggressive tightening. A plot twist at Peloton. The fitness company reports early, cuts its revenue forecast, plans job cuts, and announces its CEO John Foley will be stepping down. How does it all change the odds of a potential sale? And small business, big price pressures. NFIB optimism falls to an 11-month low with the weight of inflation and labor shortages. We'll take a closer look with Sharon Miller, Bank of America President of Small Business. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, you and I were just discussing, it feels like it should be later than the week than it is because the news flow just keeps on coming.
It continues to be brutal, and it continues to pull us in lots of different directions. What do you think? Do we get to 2% by Friday? Do you think we can expect that? We've got a lot of things to get through between now and then. Feels like a fairly big number, doesn't it? Let's talk about it. Kaylee, you raised the question, so let's dig into it. 2% is now in sight. Historically, 2% doesn't feel very high. But does it mean anything if we get to that kind of a level? Does a 2% yield really do anything for these markets? Well, let's kick it around a little bit. Kaylee and I have already been discussing it all morning. Let's bring into the conversation Kriti Gupta, Bloomberg Markets reporter, and Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence. Ira, let me start with you. Does 2% mean anything? How quickly do you think we get there? And where do you think fair value even is right now?
Sure. So, well, three different questions. So firstly, 2% really doesn't mean a whole heck of a lot. In fact, if you look at most of the charts, we're actually right there at 1.97%, which is a very important technical level for these markets. And above that, we could very quickly get to around 2 1/8 on 10-year yield. So, 2% is kind of a vacuum kind of number either side of that. Where is fair value? Fair value is actually right around where we are. So our fair value model shows for 10-year yields around 1.92, but importantly, look at where tips are, because this whole move has been all about real yields. It's not about inflation. It's not inflation going up or the market expectation of inflation going up. It's all about the Fed and hawkish monetary policy, and real yields have gone up substantially. So watch those, and those currently are approaching our estimate of fair value at around negative 40 basis points on the 10-year. Right now, they're around negative 46 basis points.
Well, as Ira points out, Kriti, real yields moving higher. The equity market doesn't always take kindly to that. Right. Is 2% a bigger threshold for the equity market than maybe for the bond market in that sense?
It kind of seems like it would be, just given kind of the carnage that we saw in 2021. I think it was about a year ago to the date where you had the kind of the meme frenzy, the idea of 10, 14 basis point moves really rocking tech and, of course, the index broadly. But I think Ira was right here, and that 2% doesn't actually mean anything, not just for the bond market, but I would argue for the stock market as well. There's always going to be those kind of short-term fears, those near-term fears that 2% is going to be kind of the shocking round number. But if you actually look historically when we have crossed that 2% barrier, I'm looking at 2013 with the taper tantrum after Ben Bernanke made that congressional testimony. Yields shot up over 2%. They were actually below before then. Same story in 2017. Right before the trade war, you also had this kind of growing in line with yields. So yes, immediately on that knee-jerk reaction, you did see a little bit of a sell-off, but it kind of or what's the word? It kind of shook it off his shoulder, whatever the phrase is.
Took it on the chin.
Yeah, there you go. It kind of rallied after.
There's a British way of saying that, guy.
There's always a good British way of saying everything. Kriti, Ira brings up inflation and says that this isn't about inflation, this move that we're seeing right now. And certainly if you look at the price action, particularly in tips, you can see the justification for that. Nevertheless, we're coming up to the big inflation print of the week. We're looking at CPI. And I'm wondering kind of which assets are going to react the most to that. Is CPI going to be something, if we get a expected or higher print, going to be enough to push us through 2%? Equity markets are starting to sell off now. Do we get a bigger reaction there? I'm wondering how inflation is going to be priced later on this week into the asset classes that we're tracking here so carefully. Where do we get the bigger reaction? Bonds or equities?
Yeah, can I take a third option, say the dollar? Because I think that's really where it's going to be the big one. The idea here is that the bond market is, of course, going to react to the CPI print, no doubt about it. But the equity market seems to lately, at least in the last couple of months, been taking their cue. The idea that it was kind of spooked by yields in 2021. Well, in 2022, it's spooked more by oil prices than anything else, which, of course, is the driver of those inflation prints. And just typically, when we get those CPI prints, you actually see CPI beat the surveyed estimate. So it's kind of that assumption that they're going to beat, and they're going to beat by a huge amount, or the CPI print is going to beat by a huge amount relative to the economic surveys that you are seeing. So that's the kind of mentality the S&P 500 or equity investors are going to be going into the print with. The bigger move is going to come from the dollar, especially because they're kind of dealing with those haven flows that are ongoing, the idea of rate differentials essentially, but also the inflation prints. And I think if you start to see a higher spike in the dollar off that CPI inflation print, that's ripple effect is what you're going to see in the S&P 500 and commodities as well, just given that they're priced in those dollars. So I'm going to use that third option, Guy. I think it's the dollar.
Guy, if I can jump in here just for a second on that. Yeah, so if you think about, my fear is that if we do get a much higher than expected, say something close to 8% on headline CPI this month, which is a non-trivial possibility, that what probably happens in the rate market is you get a significant flattening of the yield curve, and that probably will affect risk asset markets pretty significantly. So it's like the second order effect is, the curve flattens. People say, oh, the bond market is saying that we're going to have a recession next year, and that's going to hit risk assets. So credit spreads wider, equities may be somewhat lower on the back of recession fears for a 12-month forward look.
All right, so CPI, one potential catalyst this week, Ira. We also have a significant amount of supply coming online. When you look at the auction slate, you've got 3s today, 10s tomorrow, 30s on Thursday. What are you expecting in terms of what that takedown could be like and the resulting move in the bond market?
Yeah, it's hard to love these auctions, right? So we will be watching very closely what the bid to cover ratios are and who exactly gets these bonds. But remember, the Treasury Department is cutting them. So they just cut them another couple of $1 billion. 20-year next week is actually cut by $4 billion. And they're going to continue to cut auctions for the rest of this quarter. So I do think that there is a risk that that's the impetus when we get the 10-year auction tomorrow, that you could push to, you could finally see a print above 2%. In fact, the when issued issue for the 10-year is right around, a little bit under, but very close to 2% right now. So this new 10-year might, be the catalyst for that 2% number to finally be hit.
Kriti, I want to come at this from a European angle as well and figure out what is going on globally. We have seen since last Thursday a huge repricing in European bond markets to reflect that pivot that was delivered by Christine Lagarde. To what extent is that playing into this rapid move higher that we're currently seeing in the US 10-year?
Well, a good chunk of it, I would say. I would say like the latest leg higher is actually coming from essentially what you saw in those periphery yields, the Italian spread to Bunds, especially actually influencing what the yields are going to be doing. And that's really where you're seeing this kind of get closer and closer to that 2% level. That doesn't mean it's going to continue, though, because I think as you start to see more commentary coming from the Fed and a little bit more clarity about whether or not we get that 50 basis point hike in March, which I think is the real question when it comes to the U.S. bond market, at least on the surface level here. And when we're talking about those cross-asset correlations, the idea that the bond market is still pricing in a 50-50 chance of a 50 basis point rate hike in March. And I think that clarity is what's going to move the needle more than what you're going to see from other central banks around the world.
Well, Kriti, to that point, I feel like I'm seeing more and more notes out from strategists at different Wall Street banks essentially saying we've seen it all priced in at this point. This is peak hawkishness. It doesn't get any worse from here. Yeah. Do you get that sense looking at where these markets are that it's all baked in already?
It's interesting that you say that because that's what people said about the Bank of England, and yet you saw a pretty interesting reaction, right? They said it was all priced in. Yep. We know the Bank of England was very hawkish, and then here we are. And then the reaction was, well, the ball's now in Lagarde's court, right? That what the ECB does is going to create that currency moves more than anything that the central bank does. If you apply that same logic to what you're seeing here in the Fed, the idea that, yes, the Fed seems to have taken this hawkish tone, well, it's not just them, right? It's the entire world, and they're trying to target inflation, which if you look, and once again, I'm going to go global here, if you look at these attempts to target inflation from central banks around the world, emerging markets, which are far more exposed to those commodity moves than other countries, they've been trying to do this for months and months on end. This is why the Fed is behind the curve, right? Because they've been doing this way before the Fed even decided to admit that transitory wasn't worth using, the word wasn't worth using anymore, and yet they still haven't done it. So I think the bigger question isn't necessarily, is the Fed going to hike, is the Fed actually going to be tackling inflation?
Very good question. Thank you so much to Bloomberg's Kriti Gupta and, of course, to Ira Jersey of Bloomberg Intelligence. And, Guy, of course, to Kriti's point, it's not just if the Fed will hike. It's also a question of how far they will have to. With a market reacting like this, how much work has the market already done for not just the Fed, but central banks across the board?
And the market's reacted really quickly, and I think this is significant as well. And it's now starting to creep in the credit markets as well. And I think that's the real tell here in terms of the way that the market may be repositioning a little bit faster than the Fed is in some ways. If you start to see credit reacting, if you start to see that transmission mechanism being affected in the United States, then I think that is something that the Fed will pay attention to and will maybe have to sort of lean against in terms of the, it's about the pace here that I think is important, and that's what's really catching my eye here. The credit market's beginning to move. Is the Fed going to be comfortable, not with the move, but the pace of the move? Bond yields are going higher. Is the Fed going to be comfortable with the pace of the move? 2% I don't think is particularly relevant, but how fast we get there I think is. And what does that tell us about ultimately where the terminal rate is going to be as well?
Yeah, how comfortable will they be with a flatter curve as it persistently flattens? Definitely questions we will try to answer. And we'll talk about out with our next guest coming up, who thinks we may have been at peak hawkishness already. Where does he see us going from here, and what role does the retail investor have to play in all of this? We haven't seen them buying like this in about a year. We'll talk with Vijay Patel, the global macro strategist at Vanda Research, about that next. This is Bloomberg.
Season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
196.14. That is where we currently sit on the 10-year Treasury yield, getting closer and closer to that nice, clean, round 200 basis points. But our question of the day is, would a 2% yield actually mean anything? We're joined now by Viraj Patel, Vanda Research Global Market Strategist. Viraj, obviously we like round numbers. It's something that we can mark to and pay attention to. Does it actually make a difference whether we're at 2% or 1.99%?
In reality, probably not, especially for the Fed. I think really here, whilst it's really difficult to be a dove in a world of hawks at the moment, we do think that we really are approaching peak hawkish Fed. There's a couple of reasons for this. I think, one, just in terms of what's baked into the front end, this aggressive front-loading tightening is a narrative that we would want to start fading. All the talk around a 50 basis point hike is not what we see on the cards. We really just want to get that first hike out of the way and effectively see a buy the rumor, sell the fact across yields. But really what's going to be important this week is CPI, and especially tomorrow's CPI print. We think that it could come in on the softer side, especially given a lot of the factors that have been driving the upside, things like new and used car prices. We're starting to see them moderate. So, the Fed had this peak, I guess, in inflation coming in at the second half of this year. If we start to see signs of that earlier and as early as tomorrow, then I think that will be a real big wake-up call for both the Fed and markets, especially in terms of what the Fed can actually deliver in terms of rate hikes over the next couple of months.
Viraj, I hear what you're saying about peak hawkishness, but nevertheless, the inflation print is going to tell us that we are still well away from where the Fed's target is, and as a result of which the Fed is going to have to take some remedial action to get there, and that probably means taking interest rates north of 2%. we haven't fully priced that yet. Even at the front end, we haven't fully priced that yet. So isn't there more room to go in terms of yields going higher?
There's a couple of ways in which this plays out, really, over the next 2 to 3 years. On the one hand, yes, I think if central banks wanted to just take interest rates straight to 2%, in a linear fashion, back-to-back hikes like what we're seeing priced in the UK, that is one option. But, as we've learned from the post-GFC era, really, gradual and limited, it has always been the phrase. And we don't see any necessary need to veer from that messaging too fast, too quickly. At least in terms of where the landing zone is for inflation. As I said, if the top comes in slightly earlier, if we get towards a period of goods deflation this time next year, energy-based effects working their way out of the CPI print, we could be in a very different inflationary environment, one that optically looks, bad for the Fed to continue tightening in an aggressive manner. So, I think markets are really underestimating the scenario where central banks get a couple of hikes done, pause, see how the economy digests that, and then waits to get the sort of second wind of rate hikes at a much later stage.
So what does that mean for the equity market, Biraj?
Yeah, I think we're getting close to a really constructive environment for growth and tech. For one, obviously if yields do start to, at least the momentum in the sell-off in the bond market starts to wane in the next couple of weeks. The second factor is really positioning. We've seen a huge capitulation in positioning, especially across all US equity investor types based on our indicators here at Vanda. And I think that coupled with a peak in yields at some point, would be a really constructive environment for growth in tech stocks. One factor that we've also seen is retail investors buying, and that's going to be constructive as well to the that environment for growth.
Okay, so let's just dig into the retail side of things. Biraj, what have retail investors been doing during January into February? We've obviously seen huge amounts of volatility. Growth stocks have been hit particularly hard. Have they still been buying? What have they been buying? And would you expect that buying, as you suggest, maybe to shift back to growth if they've been picking up other areas once we start to see the environment you suggest will come to bear?
Yeah, at Vanda, we've noted this is a really different retail investor to what we saw pre-COVID. And, I think there's a lot of people on the street waiting for that capitulation to come through. Look, we haven't seen it. Over the past month, we estimate that net purchases by US retail investors has been around $30 billion. And that's equivalent to what we saw this time last year, at the heights of the meme stock rally. So, retail have been buying the dip quite pretty aggressively, especially on days of heavy selling. But on those rally days, what we've noticed is that all the buying has been focused on large cap techs. In particular, this phrase that we've coined here at Vanda, TAN stocks, Tesla, Apple, AMD, Nvidia, these new large cap tech stocks, which has been effectively the darlings of the retail investor world. That's where all the buying has been focused on, and that's probably where all the buying is going to be focused on in the next couple of weeks if we get a bottom in equities.
Okay. We'll see what causes that bottom in equities maybe to form. Biraj, always a pleasure. Nice to see you on the show. Biraj Patel, Vanda Research Global Macro Strategist. What are we going to be talking about next? We're going to dig into some of the corporate news we've been watching. Shares in Pfizer, a little lower today. The drug maker's latest forecast for sales and profitability coming up short. Details next. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Big changes are on the way at Peloton, the fitness company whose share price plunged after a slowdown in demand. Peloton co-founder John Foley is stepping down as CEO and will become the executive chair. He'll be replaced by the former CFO at Spotify and Netflix, Barry McCarthy. Those moves are seen as a victory for activist investor Blackwell Capital. Peloton also said about 2,800 jobs will be cut. The Australian electric vehicle charging company Tritium will build its first U.S. factory in Tennessee. President Biden and Tritium CEO Jane Hunter will make the announcement today. The plant will be located east of Nashville. It's expected to create 500 jobs and make as many as 30,000 electric chargers a year. Pfizer forecast 2022 sales and profit that fell short of Wall Street estimates. The drug maker's expectations for its coronavirus vaccine and recently cleared oral therapy disappointed investors. Pfizer's $100 billion plus target for this year would mark a record high for the company. And that is your latest business flash. Guy Keeley.
Rika, let's pick up on that Pfizer story and talk about it a little bit more. Wall Street was really bullish on what was expected from Pfizer, and you just wonder how we ended up with this gap in expectations versus reality. Let's try and kick this around a little bit. Sam Fazeli, Senior Pharmaceutical Analyst from Bloomberg Intelligence, joining us now. Sam, how do we end up where we are right now, which is a big drop in Pfizer's share price? Wall Street was expecting a lot. To be honest, Pfizer delivered a lot, but not quite enough. So how did we end up with this gap? Was it a communication problem, or was Wall Street just simply getting ahead of itself?
Yeah, hi guys. So when I look at the numbers, we have detailed estimates on Bloomberg MODL, which we can look at. You can see that the estimates they've given for Comirnaty, which is their COVID-19 vaccine for 2022, is about 2 billion shy of what consensus was looking for. So it's at 32 versus 34. And Paxlovid is at 22 versus about 25 that consensus was looking for. The question I have is, why did anyone think that consensus was going to be right on any of these numbers? If the company had all they had done was say, this is the number of doses we're going to make, that we know about Paxlovid's price in the first contract they did with the US, and that's about it. So how these numbers fall, I think, is what consensus had obviously got a bit too excited about. Now, could they do better than this? I think so. I think they could do better than this, especially on Paxlovid as the year goes on. But let's see what they say in the call with regards to the average pricing, if they ever make a comment on that.
Well, one reaction from Citigroup was about its dependency on COVID treatments and vaccines in particular, saying, quote, it remains the challenge and the opportunity. Is Pfizer at risk of becoming too COVID-oriented here?
Well, not really. I mean, they have two of the best products out there with regards to a vaccine and a drug for COVID. That's just the way it is. So let's just celebrate that. But in reality, what's happening underneath, if you take this layer of COVID away, is business as usual. Some products didn't do well because they had pressure from COVID, etc. So the company has a lot of pressure on now to utilize this cash flow in a good, accretive way. And that's going to be the interesting thing to see, because it's not going to last forever. At some point, we'll end up just taking an annual shot, perhaps, if you're over 60 or whatever. So that's the critical element here. What are they going to do to get the rest of the business to motor?
Sam, what does this mean for BioNTech out of Germany? What does this mean for Moderna? What do we learn about what is happening in the wider pharmaceutical market today? And what do we learn about what the long-term trajectory, as you say, is for COVID treatments, and how maybe that's going to fade a little bit?
Yeah, so for BioNTech, it's relatively easy. It's not that easy because it's not like they take half of what Pfizer make in terms of gross profit on the vaccine, and that's their revenue, because they sell direct into Germany and Turkey. They also have a deal in China with Fosun. So it's a bit more complicated what exactly they receive. But obviously, if Pfizer gets less, then they'll get less in terms of sales. For Moderna, it's a lot simpler. If Pfizer's doing X amount, then I think people will assume that Moderna will do just a little bit less. So for all of these vaccine makers, we're still going to be having this question, Guy. What are we going to need in terms of further shots throughout this year? And what does that mean for next year? If shots that have been contracted this year don't end up being used, does that then fall into 2023?
All right, excellent questions. We'll look for answers. Thank you so much to Sam Fazeli, Senior Pharmaceutical Analyst for Bloomberg Intelligence. And as we know, COVID has impacted inflation and the labor market. That affects small business. We'll discuss that with Sharon Miller, Bank of America President of Small Business, next. This is Bloomberg.
About that all day yesterday.
We're about an hour into the Tuesday U.S. trading session, and as usual, Abigail Doolittle is here following the moves. Abigail, it's less exciting in stocks today, more about the bond market.
It is certainly more about the bond market. Right now we have stocks fluctuating between small moves, or at least small, modest mixed moves. Bonds, though, it's very clear what's going on. We're looking at a bit of a sell-off. This is a 10-year yield over the last year, actually from the last year, and you can see right now almost at 2%. We've been talking about the possibility of 2.25, even 2.50 on this program. Well, there is 2%. That, of course, brings into question valuation on tech stocks, also the cost of money for companies, higher prices for consumers. But right now, stocks are doing relatively okay, especially, not surprisingly, bank stocks. Take a look at JP Morgan, Bank of America really eating that up. As yields go higher, of course, can help their lending activities. Oil is down a little bit today on the idea that perhaps geopolitical tensions are easing, so you can see some of the big oil names are down. One stock that's not down, in fact, up for a big way for a second day. Here's Peloton. Take a look at this over the last 2 days, now up 41% in the pre-market after reporting a very disappointing quarter, also announcing a new CEO and organizational changes. The stock had been flipping around, but right now up about 12%, up more than 12% actually, because yesterday up about 21%. So big gains for Peloton. Largely has to do with the speculation that the company will be taken over by another company. Investors, longs, probably relieved about this because this is the new range in terms of revenue, down sharply from the prior forecast and the estimates. EBITDA profit, a much wider loss than had been expected. And then, of course, subscribers of 3 million, down from what had been expected. But again, Guy, the big story in Peloton is the idea that perhaps a company, maybe Nike or Amazon, those names have been thrown out, could acquire Peloton.
Was this enough to keep the activists happy? Are the activists going to be wanting more? Are we going to see other C-suite executives maybe having to depart as well? Abigail, thank you very much indeed. Let's turn our attention to some of the data we've seen, really relevant to the U.S. economy and the trajectory we're on. Inflation and labour shortages certainly weighing on the minds of small business owners in the United States. The latest report on small business sentiment is out. The NFIB data released a little earlier on your Bloomberg terminal. Bloomberg's international economics and policy correspondent Mike McKee joining us now to sift through what we should take away from these numbers. Mike, what's the big takeaway?
Well, the big takeaway is that small business owners are starting to get less and less optimistic about the economy. As you can see here, the optimism index, the white line, has declined to 97.1. That's below the average for the NFIB numbers, and it's way below where we were before the pandemic started. They see profits falling, and as you can see with the yellow line, expansion plans have been put on hold. They're going down. And the biggest reason is they can't find workers. Here's the survey's top problems for small business owners. Labor quality and shortages, 23%. They can't find the workers they need. Inflation is now up to 22%. Right behind it, they're paying more for what they've got. Labor costs are going up, not quite as fast as their prices, but they are going up. Now, here's the interesting thing. This bears on what Abby was just talking about, higher interest rates for businesses. Only 1% say credit, the cost of credit or the availability of credit is a problem. 62% say they have no interest in borrowing right now. What are they doing about their problems? Well, they're doing what you'd think they'd do. Right now you can see the number of jobs open in white drops just a little bit, but it's still 47% have jobs open that they cannot fill, and the quality of work is a problem. The availability of labor is a problem. 55% say so they are raising prices. That's the yellow line. 61% say prices are going to go up to try to keep profit margins worthwhile.
All right, prices of everything seem to be going up. Thank you so much to Bloomberg's Michael McKee. And let's get more on the state of small business now with Sharon Miller, Bank of America's president of small business, as well as head of specialty banking and lending. Sharon, given some of those pressures that Mike was detailing to us on the labor side, on the inflation side, from your view, how resilient are small businesses right now?
Well, we did see a decline in the data for the NFIB report that just was released. However, we still see improvements when you look at the comparison year over year. So small businesses do remain optimistic. We are seeing in our own data that our deposit balances are up year over year. We're seeing demand for loans out there, and we're also seeing payments at record levels within the small business space.
In terms of what needs to happen, though, to bring supply and demand into balance, Sharon, demand is incredibly strong. Is the expectation, do you think, the demand comes down? Or do you think we're going to see some of these bottlenecks, be they labor or materials or whatever it is, starting to ease? Is there an expectation that some of these bottlenecks start to actually fade as we work through the rest of this year?
We do see and anticipate that some of these bottlenecks will begin to fade as the year moves on. We do still see, as you indicated, supply chain issues. Of course, inflation is a big issue. And I think the most relevant and what we hear about so many times, not just this report, but every time we survey our business owners, it's around finding the right labor. And that has just been even a bigger issue throughout this pandemic, getting the right skilled labor to go to work in small businesses across the country. They just can't fill the jobs that they have open.
Well, and do small businesses have more difficulty outsourcing or shifting towards automation, things that maybe larger scale companies could do in the face of labor shortages? Do they have the ability to do that?
They do have the ability, but I would say that it is more difficult in the small business space. You know, when you're competing against global corporations, it is very difficult to really keep up with the investment in technology. And so we have seen our small business owners, in fact, continue to invest in digital capabilities, and especially during the pandemic, those that had digital capabilities and were able to go online and be able to create the goods and services and really distribute those goods and services across the country through digital means, those fared much better. And at Bank of America, 85% of our small business clients are digitally active. And so when you think about the capabilities, the tools, and the resources for small business owners, not just so that they can really protect and grow their business and get through this pandemic to the other side, but also using that as a way to distribute their commerce. We're seeing more and more of that, especially coming out of the pandemic.
Sharon, what's happening with inventories? Clearly we're seeing shortages everywhere at the moment. Are these small businesses having to dedicate more working capital to inventories to make sure that they can navigate some of the supply shortages that they're seeing? And how significant an increase are we talking about?
Yes, I mean, there's certainly a pressure on inventory. You can just go to order a furniture or a car. You're waiting months and months. So this is an issue for the consumer, and for a small business balancing. Do I have the right inventory? Can I meet the demand that's out there? This is what really is that juggling act between the two. Now, we're just coming out of the holidays, and so as we talked about the January data from the NFIB report, we do tend to see a decrease because you've got a lot of demand going on throughout the end of the year in the fourth quarter, and then going into January, you do see a bit of a lull. So, although the NFIB data was a decrease versus December, I don't see it as alarming. I would say it is what we normally tend to see in the trends.
And obviously, when we're talking about inventories and the capital needs, that brings me to a question of where that money is coming from. Are you seeing small businesses being more active in seeking out loans? What does loan growth look like?
We are, and at our company, we are seeing loan demand begin to increase. We have seen pre-pandemic levels when we look at the comparison for our balance sheet for small businesses and what they are doing to access capital. So our clients are coming to us, they are accessing capital, and as you talked about this segment in the beginning, we did hear that there's not an issue so far of business owners. That's not one of their top issues in getting access to capital. And so we are seeing more and more demand that is coming. And I think it has to do with getting more inventory, taking advantage of some of these opportunities that are out there as we come out of the pandemic, and clearly hiring more employees and wage pressures.
Okay, but let's just dwell on that issue of the availability of capital. The availability of the money is certainly there. What's the sensitivity, do you think, to the cost of money? If we see the cost of money starting to go up, and we spent the program talking about 2% yields on a 10-year, clearly there is a rising cost of money right now. Where do you think that starts to have a significant impact on small businesses? When do you think actually they start to maybe reduce their desire for attracting fresh capital into the business? At what point does that come?
Well, we're still at historic lows as far as rates go. So yes, we do see sensitivity to that, but I'm not anticipating any time in the near future that would cause some sort of strain or constraint on access to capital for small businesses. We see that the demand is continuing to grow. We are at historical lows in terms of interest rates, whether you're applying for a small business loan, a mortgage, an auto loan, all of that, really, we are at historical lows.
Well, and Sharon, obviously, when we're thinking about the cost of money, a lot of that is influenced by the monetary side and conditions becoming less easy on that front. We are also experiencing simultaneously a lack of fiscal impulse that we have seen through much of the pandemic. And I'm wondering, especially as so many of these businesses are raising prices, consumers have to be tolerant of those price increases. Are we going to start to see a bit more difficulty on that front?
Well, they are raising prices. When we expected that, when the cost of goods and services are getting to, where inflation is at 40-year, where we're seeing increases in all of that. So I do think that you have to pass that along to the consumer. Small businesses cannot hold on to that. And so we have seen an increase. And then on the flip side of that, I mean, it's sort of a tale of two cities because we do see consumer spending. We just released a report yesterday on consumer spending of our clients at Bank of America is at record high. Payment rates are at record high. We're seeing small businesses continuing to spend, and in fact, that's up 22% year over year. So as you think about the demand of goods and people having money available to spend, our deposit balances are continuing to grow both in the consumer as well as in the small business segment. And that again is up, double digits from last year. So all of those point to there's a lot of cash on the sidelines, there's a lot of money to be spent, and we know that consumers fuel small business. So as consumers spend, as we see more goods and services out there, and as supply chains go abate a bit in this year, we will see the matching of goods and continuing of improvements overall for the economy.
Yep, and such an important area when it comes to labor as well. Half of private sector jobs in small businesses. So the health of this sector, critical. Sharon, it's always great to get you on the show to talk about the NFIB, to talk about what you're seeing in your data. Really appreciate your time today. Thank you very much. Sharon Miller, Bank of America, President of Small Business. Greatly appreciated. What do we got coming up for you? A shake-up at Peloton. The fitness maker replacing its CEO, cutting hundreds of jobs. Got an activist investor indicating it's not enough, though. Will more heads have to roll? Details next. This is Bloomberg.
Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. The U.S. is losing patience with China regarding trade commitments reached during the Trump administration. American officials say they haven't seen any real signs of Beijing making good on its agreements. China pledged to buy an extra $200 billion in U.S. agriculture, energy and manufactured products through the end of 2021. After taking on Spotify, musician Neil Young has set his sights on big banks. Young has called on baby boomers to, quote, ditch the companies contributing to the mass fossil fuel destruction of Earth. He proceeded to encourage people to take their money out of JP Morgan Chase, Citigroup, Bank of America and Wells Fargo. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
So we've got Neil Young, Christine Lagarde, and a whole host of other central bankers. That's an unusual Venn diagram, isn't it, Kaylee?
It absolutely is. I mean, Neil Young has made his fair share of headlines in the last week or so. First, you take your music from Spotify because you don't like Joe Rogan's podcast or Spotify's response to it. You actually see your music actually getting somewhat of a lift off of that, even removing Spotify from the equation, now taking on the big banks. And to read off the quote here, Guy, he said, join me as I move my money away from the damage causers, or you will unintentionally be one of them. So he's definitely taking an activist stand here, but I think it broadly goes to the idea of big banks, their role in financing the fossil fuels industry, and what that means from a regulatory standpoint as well.
Just from a markets point of view, though, the energy sector is having a cracking start to the year, and the banking sector is having a cracking start to the year. So just in terms of investment advice, that's a tricky one.
Maybe don't listen to Neil Young on that.
Yeah, so the music, fantastic. The investment advice, maybe a little bit different. From an ethical point of view, well, that's a whole different argument. Let's talk about something else we should focus on as well, talking about things that are changing pretty fast. Let's talk about Peloton. The stock is all over the place. That's the one-year chart. But just look at the right-hand corner. There is what looks like a fairly diminutive spike, but in percentage terms, that's absolutely enormous. Now, we've seen overnight this news coming out that there's going to be a huge shake-up at the fitness company. That's now reached the C-suite. We've got the CEO stepping down, a new CEO coming in, talk that maybe we're going to see other C-suite exits as well. What does this all mean in terms of the idea that potentially we could see an acquisition here, changes coming? Well, let's go to San Francisco and bring Ed Ludlow into the conversation. Ed, what are these changes a recognition of? Are they a recognition of that there is now a need for an acquisition, or are these changes a recognition that the company just needs a different direction?
Yeah, I mean, the stock move is crazy, right? And I think you take each of the actions in isolation. So first off, John Foley steps down as Chief Executive Officer, becomes Executive Chairman. This is a company that he founded a decade ago, right? 2012. For those on Global Wall Street that want to see this potential takeover happen, I think that, Foley stepping aside increases the likelihood that a Nike, an Amazon, potentially an Apple or a Disney could come in with a bid, right? Because of the dual class share structure.
Well, it's talking of he still remains a shareholder. He has those super majority shares. So don't you still need his sign off for any deal?
Well, that's why I point out, remember, he's the founder of this company, and it's a decade in the making, and a lot of it was around psychology, right? He personally has come under attack from Blackwells, the activist investor. They've issued a statement basically saying, we're happy that he's stepping aside. We're not happy that he's hand-picking directors for the company. So that, that's one point. The other point is who comes into the seat, right? Barry McCarthy, a well-respected former CFO of Spotify and Netflix. You have JP Morgan saying that this guy has credibility of the street. He's proven that he knows how the subscription model works. And remember, before the idea of an M&A, an acquisition, a takeover came about, the whole conversation was, what is the future for Peloton? Because it's grown to a point where it can service levels of demand in terms of the hardware, the bikes, the treadmills, that just aren't there anymore. So they wanted to see somebody that could reinvent Peloton to more of a services and higher margin revenue business.
Ed, my real question is that the famous San Francisco fog behind you, or is that kind of some sort of steam duct? Because that's the big debate now on this show, because it looks really cool, looks amazing.
It looks mystical.
I'm going to let you guys on a little TV secret. That is actually real. That is what San Francisco looks like every morning. The Silicon Valley glow is still here.
All right, well, Guy, you and I seem to be in the wrong place. I'm sitting here in my studio. It's kind of cold in here, and I know London's always gray. So, Ed Ludlow, you get the better end of the stick there. Thank you so much for joining us from a beautiful San Francisco where the sun is rising. Appreciate it. This is Bloomberg.